Too many practice owners see profit as something out of their control, just a number that is what it is. But that mindset is definitely costing you. Here's the truth. There are simple, powerful steps you can take to boost your profits, free up cash for a better lifestyle, reinvest in your business, and fast track your retirement goals. In this episode, we break down the 3 hidden profit drains that are quietly eating away at your bottom line and exactly how to fix them. So stay tuned. Practice owners, tired of working hard but not seeing the financial results you deserve? I'm Eric Miller, and my best-selling book, How to Become a Financial Beast, is your game changer. Learn how to maximize profits, pay yourself right, and build wealth outside your practice. Download now for free. Hey everyone, welcome back to the Financial Beast podcast. I'm, of course, your host, your epic host, Eric Miller, co-owner, chief financial advisor at Chronologics Financial Advisors. Here with not the chief advisor. What are you again?
The advisor of superb knowledge, debatably higher than that of the chief advisor, Eric Gersh.
Could be. So in case you don't know us, we help healthcare clients. We show you guys how to better acquire, control, and expand your money through our financial planning system that offers premier financial advice for you. And you can check us out at chronologicsfinancialadvisors.com. And as a reminder, if you're new to the channel, please leave us some comments, subscribe to our channel, and tell 3 of your friends so that they can get the knowledge that we're going to drop them today. Profitability seems to always be a hot topic for people.
Yeah. I mean, it's the basics of business, right?
It is. And, I think people look at profit in a bad way because, quite frankly, anytime that someone is profitable, specifically like big corporations, people tend to, they have like an adverse reaction to that. Like it's necessarily a bad thing. But it doesn't matter how big or small your organization is, whether you're a $10 billion organization or you're, doing $50,000 a month. You got to pay attention to your profit.
You need profit to survive.
Yeah. Profit does so many things. It will allow you to pay for your lifestyle. It will allow you to expand in the business. It will accelerate your ability to retire.
Yep.
Which is exactly what the business profit should enable you to do. All 3 of those things.
Exactly.
At a very high level. But we're going to pick on 3 things today that are reducing your ability to have a healthy profit margin in your practice, and what you can do about those things so that you become a little bit more profitable. And when we say you're profitable, like it's not like you're 5% profitable or 10% profit, 20% profit.
Yeah.
Like that's the number we've kind of come up with, 20% or more. If you want to be able to do all 3 of those things, which is, again, I'll go over them again. Have a really nice lifestyle, reinvest back into the business so that it can expand and have reserves, and so you can accelerate your ability to retire in 7 to 10 years. That's it. I mean, who wants that? Apparently nobody.
Me.
Yeah. So, all right, let's start at numero uno.
All right.
What do you think that is?
Staffing.
Oof.
Being overstaffed.
Oh, there's
too
no
much
doubt about
support
that.
staff, too much admin staff, just too many people.
You guys have too many people. I mean, this sounds terrible, but look, I mean, every single day we get profit and loss statements from practice owners, and every single day we look at the line item of wages and not necessarily benefits, because I think you need to have some good benefits for your people. You should take care of your people, right?
Yeah.
But it is the staff pay that is at 70, 75, 65% of your revenue.
Yep.
that is just too high.
Yeah, I mean, depending on your industry, I mean, obviously every industry has its own benchmarks, but there are set benchmarks on what you should be spending on staff. And these are, you know, out of all the expenses that you face as a practice owner, this is probably debatably the single most important one that you keep either at or below that benchmark, whatever it is for your industry.
Mm-hmm.
Because, you know, you kind of alluded to this, but every dollar you pay extra in wages that you don't need to, you also increase your benefit expense.
Yep.
You also increase your payroll tax expense.
Yeah, it has a bit of a ripple effect.
It does. Yeah, that's more than just wages.
So it is absolutely something that you guys got to pay attention to every single month, to make sure that you're keeping it in a range. And it's going to vary from industry to industry. I think in PT, we used to try to keep it at 50%. Now I think we're happy at 55 or 60%, to be honest with you.
Yep.
But if you guys get over that, I mean, it's very difficult to make a profit. I think in veterinarian, it's like probably maybe 45% when you include doctor pay.
Yeah, 40 to 45.
45 when you consider your doctor pay. Some of the other industries are pretty similar to that in terms of those ranges. But you got to pay attention to it. I have to. And I'm not sure that another way to look at it would just be to look at the revenue per employee. I mean, which is basically just take how many full-time employees you have, divide it in your revenue, and that'll tell you like how much you're getting per employee. And if that number is not, I mean, I've heard people say it has to be at least 200,000 per employee, to make sense.
Really?
Yeah.
Yeah, I don't know those benchmarks off the top of my head for each industry, but it's a very good point.
So you start looking at these things and this happened right before 2020 happened, where so many people were overstaffed.
Yep.
And then they realized, and then of course a lot of people got let go, and then they realized that they could do things with less. And I just think too many people right now are just overstaffed based upon the production that they're getting. Now you can go one of two ways with that. You can get rid of people, or you can track their production so that they are producing what needs to be produced, so that they warrant being on your staff.
Yeah.
I mean, that's the two ways you can handle that right there.
Yeah, you either need more money or less expense. I mean,
it's not. Yeah, I can't.
It's really that simple at the end of the day.
Can't break it down any more than that. You have to make sure that you're getting production out of your people, and if you can't quantify it, I mean, that's an issue. But the easiest way to quantify is just like I said, take your number of employees, divide it into your revenue, and try to keep it at a level that allows you to stay profitable. And if it's not, then you're not getting production from some of your staff as you should.
Yeah. And this, I mean, I'm going to say something else. This isn't really related to what you just said, but it just popped in my head. When I look, and I'm sure you'll probably agree, but when I look at, call it my best clients, I don't, my people who are most profitable, generally speaking, they're not people who skimp on wages, pay the minimum, and have constant turnover. They generally are actually paying wages above industry averages, but they have a small team, a long-term team, and they're just cohesive. There's consistency in the practice.
They produce.
Yeah,
they must produce. So you don't need to have a ginormous team to be profitable. You just have to make sure that you have people that know their jobs and that are working.
Yeah.
And, if you're doing a fairly good job as a executive and putting people in the right place and they know what they're supposed to be doing and they have a stat, it shouldn't be an issue. But, right now I think people are way overstaffed.
Yep.
Apparently. Okay. What's number 2, profitability wise?
So, number 2?
Yep.
my favorite one, because it makes everybody so uncomfortable. Price increases. It makes owners so, not everybody, but it makes a lot of owners, I don't know why, they just get weird about it, man.
Why do they pucker up so much?
Because in their head, they think that they're going to lose patience and people are going to notice and people are going to rage and they're going to be mad. And, I don't think I've ever had somebody increase prices and have more than maybe 2 people even mention it. It's not like, okay, if I stop at Starbucks every day and I get coffee and they raise prices, I'm going to notice, right?
Mm-hmm.
If my dentist, who I go to once or twice a year, raises prices by a couple %, I don't remember what the hell I paid last time I was there.
I don't either.
As long as it's not obnoxious.
Yep.
No one's going to notice.
I don't remember, honestly.
Yeah, I have no idea. I don't.
Yeah.
So.
Oh, I get it. You think you think that they're going to have an onslaught of
complaints, basically.
Of complaints because they raise prices when, in all honesty, how many times a year do people go to see, go to see someone?
Yeah.
3 or 4 times, maybe?
Oh, at most.
Yeah.
For our clients, at most, they're seeing their patients 3 or 4 times.
And I really have zero idea how much they're charging me at this point.
But yeah,
maybe I should know more about that.
But I guess what I'm getting at is the biggest obstacle to doing appropriate price increases is not the patients, it's not the staff, it's your own brain.
It's your
psychology.
Look at you. Jeez. Deep. Pretty deep. I agree. Look, you have to keep up with prices. Now, look, we have clients that don't have any control over that because their prices are dictated by insurance companies.
Of course. Yeah, there's exceptions.
But those are on the other side, you can cut out things that are not paying you very well.
Yep.
And have, a similar type of outcome. Because you're just not accepting unprofitable lines of business.
You can control who your payers are.
Yeah.
And you can, even if there's always cash-based services that you can add on.
Yeah.
So there's ways.
We used to have an exercise where we would show people, you have to look at all of your income sources.
I still use that.
Yeah. All the things that you do. And you got to determine which ones are the most profitable, the most in demand, and the easiest to deliver.
Yep.
And you should look at the amount of services that you are delivering, and those top 5 should account for most of your production.
Yeah, it's about where are the opportunities.
Yeah. And then strengthen those so that you're doing more of those things. Because ideally it's the kind of business you want, something where you're delivering a service that's profitable, that is people want, and isn't too hard to deliver for you.
Yeah, if you're a current client listening, I've done this with all my clients, but if you're working probably with some of the other guys, definitely ask them to do this with you.
Yeah, for sure.
It's a huge value add.
Yeah, it really does start to make you look a little bit more closely at your income sources.
Yep.
Inside your business. Okay. What's number 3?
Number 3, keeping your patients on the appropriate, call it treatment regimen, right? So say I'm an optometrist. Patients need a annual eye exam, right? What does annual mean?
Every year.
It's supposed to mean 12 months, but a lot of times it ends up being 16 months or 17 months or whatever the number is.
Mm-hmm.
And that's, over the course of 3 years, if you play that out for 3 years' time, you're getting 2 visits when you should have gotten 3. And that's money played out across a couple thousand patients. It's huge. So, and it's same thing with dentists. You get your teeth cleaned or your pets. You have the annual wellness visit. No matter what industry, probably besides PT, because they're generally injury specific, but most of the industries we work in have some sort of built-in regimen that patients are supposed to follow. So I've been having a lot of clients lately look this up because most EMRs or computer systems will give you the stats on what the average is. And I'm having them, look at, and we're discussing, okay, how can we get this down?
Yeah. Yeah, because that's lost income right there.
Yep.
So, and it's one of those sneaky little things like inflation where you don't necessarily see it or feel it. But when you're dealing with, a practice that has thousands of patients that they see, and all of a sudden you're seeing people every 16 months as opposed to every 12 months. I mean, you can probably work backward and do the math, but I'm going to assume that could be tens of thousands of dollars a month.
Oh yeah.
That could affect.
Yeah. It's going to be a lot. Yeah. And that's just the exam. I mean, think about the, like in the optometrist example, new glasses, frames, contact sales, there's.
Yeah, it's a lost it's a lot other lost opportunities that could be there for them to, sell them certain services.
And I remind people too, it's not just, I mean, obviously there's a business component to it, but it's also the best medicine, right? It's what's best for the patient. So you're not bringing your, 18 months down to 13 months just to be greedy. You're doing it because it's what you're supposed to do.
So how does this happen?
I think it's just a combination of, like if I have an annual appointment, right? I book it out a year. Obviously, no one knows their calendar a year from now. Patients reschedule or they don't show up because they forgot. And then they got to get back on the books. And, time just builds in just because of life. I don't think it's anything malicious by any means. I think it's just life and human nature.
Yeah.
But
so
you as the owner and your staff have to be the ones to, keep that regimen in place. The patients aren't going to do it themselves.
So I had this week a dentist appointment and an optometry appointment. Okay.
Okay.
You know how many reminders I got from each?
You're either going to say a lot or zero.
I got a lot.
Okay.
I got a lot.
I just did the same last week. I got like three or four.
I got 4 reminders from each of them. 4. Yeah. And even then it was like, I think that it was like the second or third reminder that I was like, oh shit, I got to make sure that I keep this appointment,
Yeah.
So whatever you guys think that it takes to keep people on the books, I think you should multiply that by 2.
Yeah.
It
takes more.
And it just takes more to keep people on the books.
Yep.
So make sure, maybe we should do something like that for us too. Make sure they have multiple reminders.
Yeah.
But yeah, I mean, that's kind of a big deal. I was just thinking about that. Like, wow, I got like 4 reminders.
Oh yeah. I get calls, I get texts, I get an email, I get, all of them. And I usually get, 1 call, 1 email, but I usually get, probably 2 texts, maybe 3.
Yeah.
So, and nowadays, I mean, if you're not doing, I feel like text reminders are probably the single most successful thing.
Oh, there's no doubt about
everyone
it.
Everyone has their phone in their hand all day.
Yeah. I mean, and an email is almost like a text reminder because most people have their email go directly to their phone.
Yeah. I don't know. I mean,
I think so.
I don't think emails is good especially for things that are rare. I mean, I get like 100 emails a day. On my personal. I do too, but I did get one. I barely read. I did get one from the optometrist, and it was just like, here's one that just happened 19 hours ago. Yep. Quick appointment reminder, right there. Yeah, firm. That's what it takes. Yep. I mean, that's exactly what it takes. So, yeah. I feel like we should give people a bonus one. Is there a bonus one on your list? Yeah, let's use accounts receivable. Yeah. Collecting appropriately and aggressively. I see this a lot. Everybody has AR problems. Those of you who deal with AR, I know vets really don't, but all the other industries do. Everybody's always complaining about AR. Yeah. And well, the coding is complex.
The denials happen at a much more rapid rate.
Yep.
Like you need to keep track of that, like on top of that, almost on a daily basis.
And I feel just by the nature of the job, like being an accounts receivable person, it's hard. I guess what I'm saying is it's hard to find the right person. You can find a lot of people that will do it, but finding someone who truly does the job, that's tough.
You're right. So there's
a lot of turnover.
There needs to be characteristics of someone that's in charge of your AR.
Yep.
All right. So what would be one characteristic?
Well, I think number one is they're a go-getter, right? AR is chasing money. It's chasing something.
They got to like the game of it.
Yeah. Exactly. Yeah. And, side note, I think with AR, the best way to pay the AR people, obviously there's going to be a salary component, but there should be a bonus component to your AR person.
Yeah, I agree.
Because if you're not bonusing your AR person, what's the difference between if I collect 80% or 83%? It's not big enough for the owner to really fire me over, but, you got to incentivize is what I'm saying.
Absolutely. So they have to be a go-getter. They got to be willing to call and talk with people.
Yep.
They're going to have to be on the phone a lot.
Yep.
With people.
And there's a lot of people that don't like being on the phone. That's for sure.
They have to be precise to make sure that, things get done right in the first place. So they don't have to go chase up, a lot of money. They got to be persistent. They got to have a bulldog mentality. And these are all the characteristics of the people that are in your, if you got lazy, incompetent, irresponsible people, you're just throwing money away.
Yep.
On that. So 100%. We could probably do a whole podcast on that, but
I'm sure we could.
Anyway. Okay, good. So those are those are 4 profitability levers right there that you guys can all implement. You guys can all do that are going to help make your profit better. And when your profit is better, it makes our lives better, because as financial advisors and investment managers, we want to make sure that you can't pour from an empty cup about that. And if you guys want to have a successful retirement where you have multiple income sources, where you have tax-free income, where you have no debt, where you have whatever it is that you want to have, then the profit needs to be there for us to be able to do that. And, we've had people that have retired in 7 to 10 years because they owned a practice, doing $1.5 million, maybe $2 million a year, but they were smart on how they allocated their profits.
Yeah, you don't have to have the biggest business.
No, you don't need like a $10 million or $5 million practice to be able to do this. Even like a 1.2 to 1.5 to $2 million practice, telling you can do it, and you can do it quicker than what most of you are doing right now. So make sure you guys check us out at thecounterlogicsfinancialadvisors.com, schedule an intro call, and we can certainly help you out with that. Okay. I think that's good.
All right.
We'll see you guys on the next podcast.